How to use Fibonacci retracement in Forex and stock trading. Fibonacci retracement is one of the most popular technical analysis tools used by traders in the Forex and stock markets. Named after the famous Italian mathematician Leonardo Fibonacci, this tool is based on the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones. The Fibonacci retracement tool is used to identify potential support and resistance levels, which are critical for making informed trading decisions. In this video, we will explore the concept of Fibonacci retracement, how it works, and how you can effectively use it in your Forex and stock trading strategies. By the end of this guide, you will have a solid understanding of how to apply Fibonacci retracement to improve your trading performance. Understanding Fibonacci retracement. What is Fibonacci retracement? Fibonacci retracement is a technical analysis tool that uses horizontal lines to indicate areas of support or resistance at the key Fibonacci levels before the price continues in the original direction. These levels are derived from the Fibonacci sequence and are expressed as percentages: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. The idea behind Fibonacci retracement is that after a significant price movement, either up or down, the price will often retrace or pull back to one of these key Fibonacci levels before continuing in the direction of the original trend. Traders use these levels to identify potential entry and exit points, as well as to set stop loss and take profit orders. The Fibonacci sequence and ratios. The Fibonacci sequence is a series of numbers where each number is the sum of the two preceding ones. The sequence starts as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on. The Fibonacci ratios are derived from this sequence. The most important ratios for traders are 23.6%. This is derived by dividing one number in the sequence by the number 3 places to the right, e.g., 21/89 equals 0.236 or 23.6%. 38.2%. This is derived by dividing one number in the sequence by the number 2 places to the right, e.g., 21/55 equals 0.382 or 38.2%. 50%. Although not a Fibonacci ratio, the 50% level is often included in Fibonacci retracement tools because it represents a halfway point and is psychologically significant. 61.8%. This is derived by dividing one number in the sequence by the number 1 place to the right, e.g., 21/34 equals 0.618 or 61.8%. 78.6%. This is derived by taking the square root of 61.8%. Square root 0.618 equals 0.786 or 78.6%. These ratios are used to draw the Fibonacci retracement levels on a price chart. How to draw Fibonacci retracement levels. Step 1. Identify the trend. Before you can draw Fibonacci retracement levels, you need to identify the prevailing trend. Fibonacci retracement works best in trending markets, whether it's an uptrend or a downtrend. Uptrend. In an uptrend, the price is making higher highs and higher lows. To draw Fibonacci retracement levels in an uptrend, you start at the lowest point, swing low, and draw up to the highest point, swing high. Downtrend. In a downtrend, the price is making lower highs and lower lows. To draw Fibonacci retracement levels in a downtrend, you start at the highest point, swing high, and draw down to the lowest point, swing low. Step 2. Draw the Fibonacci retracement levels. Once you've identified the trend, you can draw the Fibonacci retracement levels using the following steps. Select the Fibonacci retracement tool. Most trading platforms, such as MetaTrader, TradingView, and others, have a built-in Fibonacci retracement tool. Select this tool from the toolbar. Click on the swing low and drag to the swing high, uptrend. In an uptrend, click on the swing low, the lowest point, and drag the tool up to the swing high, the highest point. The Fibonacci retracement levels will automatically be drawn on the chart. Click on the swing high and drag to the swing low, downtrend. In a downtrend, click on the swing high, the highest point, and drag the tool down to the swing low, the lowest point. The Fibonacci retracement levels will automatically be drawn on the chart. Step 3. Analyze the retracement levels. Once the Fibonacci retracement levels are drawn, you can analyze them to identify potential support and resistance levels. The key levels to watch are 23.6%. This is the shallowest retracement level and often acts as a minor support or resistance level. 38.2%. This is a moderate retracement level and is often considered a key level for potential reversals. 50%. This is a significant psychological level and often acts as strong support or resistance. 61.8%. This is the most important Fibonacci retracement level and is often considered the golden ratio. It is a key level for potential reversals. 78.6%. This is a deep retracement level and often acts as a strong support or resistance level. How to use Fibonacci retracement in trading. 1. Identifying potential entry points. One of the primary uses of Fibonacci retracement is to identify potential entry points in the direction of the prevailing trend. Here's how you can do it. In an uptrend, after a price pullback, look for the price to find support at one of the Fibonacci retracement levels, e.g., 38.2%, 50%, or 61.8%. Once the price bounces off the support level, it may be a good time to enter a long position. In a downtrend, after a price pullback, look for the price to find resistance at one of the Fibonacci retracement levels, e.g., 38.2%, 50%, or 61.8%. Once the price rejects the resistance level, it may be a good time to enter a short position. 2. Setting stop-loss orders. Fibonacci retracement levels can also be used to set stop-loss orders. Here's how. In an uptrend, if you enter a long position after a price pullback, you can place your stop-loss order just below the Fibonacci retracement level that acted as support, e.g., below the 61.8% level. In a downtrend, if you enter a short position after a price pullback, you can place your stop-loss order just above the Fibonacci retracement level that acted as resistance, e.g., above the 61.8% level. 3. Setting take-profit orders. Fibonacci retracement levels can also be used to set take-profit orders. Here's how. In an uptrend, if you enter a long position, you can set your take-profit order at the next Fibonacci extension level, e.g., 127.2%, 161.8%, etc., or at a previous swing high. In a downtrend, if you enter a short position, you can set your take-profit order at the next Fibonacci extension level, e.g., 127.2%, 161.8%, etc., or at a previous swing low. 4. Combining Fibonacci retracement with other indicators. While Fibonacci retracement is a powerful tool on its own, it can be even more effective when combined with other technical indicators. Here are a few indicators that work well with Fibonacci retracement. Moving averages. Moving averages can help confirm the trend and provide additional support or resistance levels. For example, if the price is above a moving average, it confirms an uptrend, and you can look for buying opportunities at Fibonacci retracement levels. Relative Strength Index, RSI. The RSI can help identify overbought or oversold conditions. If the price is at a Fibonacci retracement level and the RSI is in overbought or oversold territory, it may indicate a potential reversal. Trend lines. Trend lines can help confirm the trend and provide additional support or resistance levels. If the price is approaching a trend line in a Fibonacci retracement level, it may indicate a strong support or resistance area. Common mistakes to avoid when using Fibonacci retracement. 1. Using Fibonacci retracement in a sideways market. Fibonacci retracement works best in trending markets. In a sideways or range-bound market, the price may not respect the Fibonacci levels, leading to false signals. Always make sure to identify the prevailing trend before using Fibonacci retracement. 2. Ignoring the 50% level. While the 50% level is not a Fibonacci ratio, it is a psychologically significant level and often acts as strong support or resistance. Many traders make the mistake of ignoring the 50% level, but it can be a key level for potential reversals. 3. Overcomplicating the analysis. Some traders make the mistake of overcomplicating their analysis by using too many Fibonacci levels or combining too many indicators. Keep your analysis simple and focus on the key Fibonacci levels, 38.2%, 50%, and 61.8%, and a few complementary indicators. 4. Not using stop-loss orders. Fibonacci retracement levels are not foolproof, and the price may not always respect them. Always use stop-loss orders to manage your risk and protect your capital. Unlock the power of Fibonacci retracement for smarter trading. Like, subscribe, and hit the bell for more expert strategies.